Welcome to Silviaco Tax Consultants. Today we are going to explain Rafael Nadal case, his tax implication and transaction recommendations. Rafael Nadal is a Canadian resident and the sole shareholder of Tennis Ltd. He also owns a rental property for $1 million. He doesn't have a will or life insurance, and he's worried about the future of his wife, daughters, and company. Last week, Rafael Nadal, he came on our office and he expressed that if the consultancy and estate planning is too complicated, he will sell the shares and rent that property to his wife and daughters, or they will receive them when he dies. After reviewing all possible scenarios and tax implications, our advice is the following. First of all, we recommend Rafael to hire a real estate appraisal practitioner. Having a wrong fair market value can significantly affect his tax implications. We are worried that Rafael doesn't have a will. If he dies, his family will assume a total taxable income, including capital and depreciable properties, of $4.6 million, which 1/3 will be assigned to the spouse and the remaining 2/3 to the daughters. However, if Rafael insists in selling his assets under Section 69, he not only will lose the control of the corporation, but also if the family wants to sell the assets to a third party, they will assume an additional capital gains of $14.8 million. Rafael, we understand that all the tax implications, that sounds like a huge amount of money, but here are the possible options. Do a rollover, create a holdco, do a estate freeze, or create a trust.
Section 85 of the Income Tax Act enables Rafael to transfer his current assets to a corporation without immediate tax consequences. If Rafael doesn't file Section 85 rollover, his transaction will be reassessed and his sales price will bump up to the fair market value of the assets, resulting in the recognition of capital gains and the recapture of capital cost allowance. Let's take an example in the absence of Section 85 rollover. If Rafael's assets are $1.9 million and he paid only $1 million for them, then he'll have capital gains tax on the gain of $900,000 plus a recapture of $200,000. In normal situations, the elected amount for capital property will be the adjusted cost base of the asset, and for depreciable property will be the undepreciated capital cost. However, some mistakes arise when the consideration received by the seller is higher or lower than the fair market value transfer. If the fair market value of considerations received by Rafael on the rollover is lower than the fair market value of the assets transferred to the corporation, the excess will result in a gift. For instance, if Rafael wants to roll over property to Tennis Ltd. At the fair market value of $1.9 million in exchange of a note payable of $100,000 and preferred shares with a fair market value of $1.7 million, he will end up paying $50,000 in taxable gain. On the other hand, if the fair market value of the property transferred is lower than the fair market value of consideration, there will be an Implication Income Tax Act 15(1). For instance, if Rafael wants to roll over property to Tennis Ltd. At the fair market value of $1.9 million in exchange of a note payable of $400,000 and preferred shares with a fair market value of $1.7 million, he will end up paying $200,000 in income tax. Essentially, the fair value of property disposed of to a corporation must equal the fair value of consideration received. It is important for Rafael to take note that a Section 85 rollover provides only a deferral of tax.
In order to do a corporate reorganization, the one possible scenario is the creation of a holdco. This will be taxed under Section 84.1. In this case, Rafael needs to fulfill the following requirements. The person or the company must be a Canadian resident. Does not deal at arm's length. The transfer of vendor must be a taxpayer. Immediately after the transfer, the subject corporation and purchase corporation must be connected. Rafael will sell all his common shares of Tennis Limited to the new holdco, where he will be also the only owner in exchange for preferred shares. If he's doing correctly, the tax consequence will be as follows. The ACV equal to 1,000, reduction of PAC equal to 2,900,000 and a tax PAC of 1,000. By doing so, will be a dividend and capital gain equal to 0. However, if the no-share consideration will be greater of the ACV of the old shares, the tax implication for the creation of the holdco will be evaluated on the section 84.1.b. As an example, let's say that Rafael wants to take 100,000 in cash. The new ACV will be equal to 0, the reduction of PAC equal to 2,900,000, the tax PAC equal to 0. In this case, as we showed in the graph, the dividend will be equal to 99,000. By doing that, the taxable income will be 150,083. The other case will be the reorganization of capital using the figure of the state freeze, which is evaluated on the section 86.1. In this case, Rafael will exchange the common share for the preferred shares. The condition of the state freeze will be: the taxpayer must be sell all his shares of the class. The shares must be capital property. The section 85 must not apply for the sale, section 86.3. The taxpayer must receive shares of the same corporation for the old shares, and the taxpayer may receive no share consideration. If Rafael will elaborate a correct state freeze, the tax implication will be equal to the elaboration of a correct holdco with a dividend and capital gain equal to 0. In the case of benefit or gift, the section 86.2 applies. As an example, Rafael will give to his daughter 100,000 of gift. In this example, the tax implication will be measured on the section 86.2. Will be a gift of 100,000, a dividend of 99,000, and a capital gain of 50,000.
After the estate freeze, Rafael and Nadal will no longer own any common shares of the company. Since preferred shares have a fixed value, any growth in the company will accrue to the new holders of the common shares. Our company believes that setting up a family trust will help Nadal optimize his goal of deferring taxes while keeping control of his company. Once a family trust subscribes for new common shares, all future growth in the company will accrue to the family trust. Nadal can maintain voting control of the company by obtaining preferred voting shares during the estate freeze, as well as by being a trustee of the trust. This will also give him flexibility to decide who is in the best position to operate Tennis Limited in the future. The family trust can receive income such as dividends from Tennis Limited and allocate some or all of it to the beneficiaries. In this way, Nadal can ensure his children receive funds from Tennis Limited as he wishes. Furthermore, as a trustee, Nadal can decide how much each family member receives from the trust. The trust can deduct income that is payable to its beneficiaries in order to reduce its own tax burden. Some jurisdictions also do not allow minors to hold shares in a family corporation, so this will allow Nadal to enable his granddaughter, who is his best hope of running the company, to benefit from the growth of Tennis Limited. Other benefits of the family trust include income splitting with lower income family members. If some beneficiaries are in a low tax bracket, such as Maria and his granddaughter, income could be paid out to them to lower the trust tax burden. Another advantage of an inter vivos trust is the avoidance of probate. Since probate only affects assets you own at the time of your death, the assets Nadal faces in an inter vivos trust are not owned by him, and therefore there is no probate on these assets. If Tennis Limited is eventually sold, a family trust potentially provides for the multiplication of the $835,714 lifetime capital gains exemption on a sale of qualifying small business corporation shares. That is, it may be possible to allocate a capital gain upon sale of Tennis Limited to Nadal's spouse, children, and grandchild, which means substantial income tax savings. Other options outside of a family trust could be that Nadal's children subscribe to the common shares directly. However, since Nadal is unsure of which of his children is best fit to run the company at this stage, introducing members to a family trust will allow him better flexibility in managing his company. Similarly, a holding company can also be used to subscribe directly to common shares. However, our company suggests that Nadal make a holding company the beneficiary of the trust, as this will give the trust the same benefits as a holdco, such as creditor proofing. Some things that Nadal should keep in mind when setting up a trust is that inter-people's trusts are taxed like individuals. However, with options such as income splitting, the tax burden can be reduced. There are high initial costs to setting up a trust, and he also needs to keep in mind that Nadal's granddaughter, who is a minor, will be subject to the kiddie tax if she's allotted dividends.
To recapitulate, Rafael should roll over his rental property to Tennis Ltd. Afterwards, he should do an estate freeze in exchange of voting preferred share. And finally, he should create an inter-people trust. In addition, Rafael should consider taking life insurance. First of all, to mitigate the tax liability of his assets, such as his preferred shares, but also to cover his funeral costs and to increase his estate to a succession tax-free. Rafael should also consider a will to transfer his assets in the most tax-efficient manner as mentioned before. For example, he should roll over his RRSP and principal residency to his wife at cost. Furthermore, Mr. Rafael Nadal should consider to draw a mandate in anticipation of incapacity to take care of him, his assets, and business in case of incapacity. Finally, Rafael Nadal should consider investing in TFSAs and RESPs to take advantage of their respective tax benefits and also to support his granddaughter's education. We thank you for your attention and hope you will continue to work with us, Silviaco Ltd. Notice that the invoice for our services will shortly come by mail.